A few years ago, raising money as a startup felt almost routine. Founders with a strong pitch deck, a compelling story, and early traction could secure funding quickly. Venture capital was flowing at an unprecedented pace, valuations were rising, competition between investors was intense, and startups often had multiple offers to choose from. It created an environment where capital seemed abundant. But that environment has changed. Today, many startups are discovering that raising money is significantly harder than it used to be. Funding rounds take longer, investors are more selective, and deals that once seemed easy to close are now falling apart. At first glance, it might look like a simple downturn in the market, but the real reason runs deeper. This isn't just a temporary slowdown, it's a structural shift in how capital is being allocated, and it's reshaping the entire startup ecosystem. To understand what's happening, you have to look at how the role of venture capital has evolved. For years, venture capital was driven by growth above all else. Startups were rewarded for scaling quickly, capturing market share, and expanding aggressively, even if they were losing money. The assumption was that profitability could come later. As long as a company was growing fast, investors were willing to keep funding it. This created a cycle. More capital led to faster growth, which led to higher valuations, which attracted even more capital. But that cycle depended on one key condition: cheap money. When interest rates were low and capital was abundant, investors were more willing to take risks. The opportunity cost of investing in startups was relatively low, and the potential upside seemed worth it. But as financial conditions changed, that equation shifted. Capital is no longer as cheap or as easy to deploy, and when that happens, investors become more cautious. Instead of chasing growth at any cost, they start focusing on fundamentals. They ask different questions. Not just, how fast is this company growing, but can this business sustain itself? Not just, how big could this market be, but how real is the demand today? This change in mindset is one of the biggest reasons startups are struggling to raise money, because many startups were built for a different environment. They were designed to prioritize growth over efficiency, expansion over profitability, and vision over execution. And while that worked in the past, it's much harder to justify today. Another major factor is competition for capital. While startups are still seeking funding, investors now have more alternatives. They can invest in established companies, infrastructure projects, or assets that offer more predictable returns. In a higher rate environment, safer investments become more attractive. This means startups are no longer competing only with each other for funding. They are competing with entirely different asset classes, and in many cases, they are losing that competition. There's also a shift happening inside venture capital firms themselves. Many funds raised large amounts of money during the peak years. Now, instead of deploying that capital as quickly as possible, they are pacing their investments more carefully. They are reserving more capital for existing portfolio companies, supporting the startups they have already invested in rather than taking on as many new risks. This reduces the amount of funding available for new startups entering the market. At the same time, expectations have increased. Investors are no longer satisfied with just an idea or early traction. They want to see clear business models, strong unit economics, and a realistic path to profitability. Startups that cannot demonstrate these things are finding it much harder to secure funding. This is especially challenging for early-stage companies, where uncertainty is naturally higher. Another important shift is valuation discipline. In the past, valuations often increased rapidly, sometimes disconnected from actual business performance. Today, investors are more cautious. They are less willing to overpay, and they are more focused on aligning valuations with fundamentals. This creates tension. Founders who are used to higher valuations may be reluctant to accept lower ones, leading to delayed or failed funding rounds. At the same time, investors are unwilling to compromise on pricing. The result is a gap between expectations and reality, and that gap is slowing down deals. There's also a psychological component to this shift. When markets are strong, confidence is high. Investors move quickly, competition drives urgency, and deals get done faster. But when conditions become uncertain, behavior changes. Investors take more time. They conduct deeper due diligence. They become more selective. Even good companies can struggle to raise money simply because the process has slowed down. Another factor is the maturity of the startup ecosystem. Over time, the number of startups has grown significantly. This means there are more companies competing for the same pool of capital. At the same time, not all of these companies can succeed. As the ecosystem matures, investors become more selective about which companies they back. They focus on quality over quantity. This naturally makes it harder for the average startup to stand out. But perhaps the most important reason is a shift in what investors value. In the past, the focus was on potential. Today, the focus is on proof. Investors want to see real customers, real revenue, and real traction. They want evidence that a business works, not just that it could work. This raises the bar for founders. It means that building a strong business is no longer optional, it's essential. And it means that raising money is no longer just about telling a compelling story, it's about demonstrating real performance. This doesn't mean that opportunities have disappeared. Startups are still being funded, new companies are still being built, innovation is still happening. But the environment is different. It's more disciplined, more selective, and more focused on long-term sustainability. In many ways, this shift is a correction. It's a move away from an environment driven by excess capital and rapid growth toward one that rewards strong fundamentals and resilient business models. For startups, this creates both challenges and opportunities. It's harder to raise money. But the companies that do succeed are often stronger, more efficient, and better positioned for long-term success. And for founders, the lesson is becoming clear. The ability to raise capital is no longer the advantage it once was. The real advantage is building a business that doesn't depend on it.